Dividend investors, bonjour. This is Mike Roux, founder of Dividend Stocks and passionate investor. I'm here today to help you invest with more conviction so you can enjoy your retirement. If you're new to this channel, we are talking about dividend growth investing, and the first thing that you should do is to subscribe to the channel to make sure that you get your notification whenever I publish a new video. A few weeks ago, I've done a webinar about payout ratios and how to protect your dividend. And one question that kept coming back was how Enbridge is able to pay its dividend, and is Enbridge dividend safe? So I decided to do an entire video about that. We'll go through the entire business model, and then we'll look at how they have been able to increase their dividend. And what's happening right now is when you look at the stock, it offers a super high yield. We're talking about like something like around 8%, and it shows 25 years of dividend growth. When you look at that, you're just thinking there's something wrong. You know, the company's growing, the yield is super high. What's going to happen next? Are we going to suffer from a dividend cut? Let's dig a little deeper into that. First thing that you want to do is to look at payout ratios, right? Most investors are thinking, oh, you know what? The best way to determine if a dividend is safe is to look at the payout ratio or the cash payout ratio. Well, in case of Enbridge, it's quite confusing because both payout ratios have been either negative or over 100% for the past 3 years. When I look at a stock and the company is offering a huge yield like 7, 8, 9% as Enbridge is doing right now, and on top of that, the payout ratio is super high for several years in a row, this screams for dividend cut. But let's not go there yet for a moment. Let's go back to the very first thing that you should do for any kind of company. If you want to know if the dividend is safe or not, the first thing you need to know is to understand how the business is making money. What's their business model? So let's go back a little bit and check at what's happening with Enbridge. Actually, Enbridge is a huge pipeline company, but it's not only taking care of crude oil transportation, it's also taking care of a lot of natural gas transportation. So basically, the company is roughly half a liquid pipeline, and then you have natural gas, and then natural gas storage and transmission. They have lots, like they have 3.8 million utility gas customers, and they have a tiny bit of renewable energy. Now, if you haven't not looked at my video about my best renewable energy stocks, just go in the link below. It's over there. I did that video about a month ago, and I'm pretty sure that it's going to give you some great ideas about investing. Moving on with Enbridge, what we look here is a well-diversified business model across Canada and the US. Still a lot dependent on liquid pipelines for obvious reason, but then at least I like that the fact that their business is slowly moving towards other sources like renewable energy and natural gas. What is really important when you look at that is consider pipelines are like toll roads, and Enbridge works with long-term contracts. We're talking like 15, 20, 25 years with their most important clients. So basically, they have those huge long-term contract with escalator rates. So this means that every single year the price goes up a little bit higher. And the way those contract works is that they usually have a minimum of utility to be paid every year. So this ensures stable cash flow for the business. Now you want to go a little bit deeper into that analysis and look at how their clients are doing. What you can see here is the percentage of investment grade businesses. We can see that most of their clients, depending on the type of companies, always more than 90% of their clients are investment grades. This means that they have a strong credit rating and they should honor their contract. A few companies that I don't necessarily like that much. We're talking about companies like BP or Suncor that didn't do so well over the past few months. But we're not at a point where we're worried about their ability to keep going in their business, because all credit analysts, they're looking at their business model, they're looking at their debt size and their ability to pay that off, and they're just saying, you know what, it's still investment grade. Most of them are like at the lower level, but still you don't have to worry too much on this part. At this point in time, it is relatively safe. What is encouraging in the liquid pipeline business is now refineries are starting to be a little bit more active. In terms of percentage of utilization, it goes between 70 to 85%. So it's getting a little bit better. We can see that the economy is coming back. It's going to be a rough ride, but overall, if we expect right now that after the lockdown, this is the worst period that we can have, we can still see that people need oil, and that the need for having pipelines like Enbridge is very important still. It's not going to go away anytime soon, and in the meantime, it's a very decent business model. In terms of natural gas, perspectives are even better. Obviously, when you think about it, when natural gas price is very low, it's not super great for those who extract the natural gas, but for those who transport it, it's great because the demand will be there. Natural gas is cheap, so it will be used by many industries. They will sometimes change their power settings and their infrastructure to use natural gas instead because of the low price. So usually low natural gas price means a healthy economy, source of growth. So on this point, in this part of the business segment, we expect that Enbridge is going to do well. Remember, it's roughly 40% of their business between transmission, utility, and storage. So therefore, it's a pretty good growth vector for Enbridge going forward. The most interesting part, though, is their transition towards greener energy. Over the past few years, Enbridge has developed several projects in North America and in Europe. We're talking mostly wind farm, but a little bit of solar as well. And they are exploring actually other sources of energy. Basically, what they notice is that the world is moving and they have to move along with it. And that's what I like about this business, is that they are able to adapt their business model. They didn't stick to their business model of having liquid pipelines. They're actually moving slowly but surely towards a more diversified and a greener business model. What you can see here is the evolution of the business model from 1949, which was 100% liquid pipelines, and I bet it was a great business back then. But then, slowly but surely, they have increased their exposure to natural gas. They did a huge transaction in 2017 by buying Spectra for $37 billion, Canadian dollars, obviously. And today, in 2020, they show 42% natural gas, 53% liquid pipelines, and then 5% of renewable energy. Let's hope that this part is going to grow and we're going to see a smaller part for liquid pipelines. But in the meantime, it is not that bad. So overall, what we have seen so far is the business model is strong, the company is adapting, and they can count on credit-worthy clients to pay their toll for a long-term contract. So far, so good. It doesn't scream dividend cut anywhere, so we're good. Now let's dig into the numbers. And numbers are especially hard to understand with pipelines because they are capital intensive, they have huge projects, they spend billions of dollars each year to either improve their pipelines, grow them, maintenance, and so on. So when you look at their payout ratios, you will usually have incredible and ridiculous numbers. If you go deep inside their financial statements, you will see that they're making a lot of adjustment to make you understand what is really happening with the business. Here you have a slide where you have the adjusted EBITDA, adjusted earnings, and then something weird called the distributable cash flow. This is the money that once all financial statements are squeaked and tweaked and so on with all kind of calculation, you get that magic number telling you what's really going on with the business. You can see here on this graph, on this chart, how they calculate the adjustment, and there's a lot of them to tell you that in the end, for the third quarter, Enbridge has generated a distributable cash flow per share of $1.03. Now, keep in mind they're paying 81 cents in dividend that quarter, so payout ratio is still the norm. The distributable cash flow is fairly stable. Last year we were at $1.04, now we're $1.03, so not even a 1% decline during like one of the worst period ever for the oil industry. So when you see how Enbridge took a hit, it's probably not justified, because when you look at their business model, it seems still safe. The problem here is what's going to happen in the next 5 to 10 years with their oil and gas client. Many of them, like Suncor, are sitting on like huge assets of oil sands, but it costs a fortune to extract. So whatever is in production right now, it's not a problem. Going forward, they will have a hard time to justify new investment, and we're not quite sure if it's going to work out for those businesses. And the reason why the market is not bullish about Enbridge is not about the numbers that we are seeing today, but rather if they will be able to keep up with those numbers, if any of those big clients have to go default on their contract. When we look at how the dividend has been indulged and how the distributable cash flow has been managed over the past couple of years, we can see that the business is generating tons of cash flow, and actually Enbridge shows a payout ratio between 65 to 70%. This year, expected distributable cash flow per share will be between $4.50 and $4.80, which will bring the payout ratio between 67 to 72%. That's pretty much their goal. They expect to grow their cash flow by 5 to 7% throughout 2022. And what I like about Enbridge management team is usually when they make a promise, they follow through. Over the past few years, they have guaranteed a 10% dividend increase. They have delivered. They have been telling us how they will finance their project and how they will grow their cash flow and how they will maintain their cash payout ratio. And they actually succeeded in all those promises. 25 years of dividend growth, and they're still on target with what they're doing. I think that they deserve a little bit more trust than the market is willing to give right now. And after doing this kind of study, I feel a little bit more comfortable about owning shares of Enbridge. Now, the tricky part, and you're going to tell me, yeah, but Mike, how about debt? Because debt will determine if the company is able to move forward or not. And let's talk about that for a second. Let's look at this graph and realize that the purchase of Spectra in 2017 kind of created a huge hole in their balance sheet. The debt level went from roughly 40 billions to 67, and it's pretty stable for the past 3 years, but that's a lot of money. The company has been able to make their payment and have been able to increase their dividends since then, but we might think that such a huge jump could kind of like hurt the balance sheet, right? So let's take a look at how credit rating agencies are seeing Enbridge. Right now, they're rating BBB plus or Baa2. What exactly does it mean is basically they're investment grade, but they're part from the lower part. The company knows what they're doing. They have their funding plan. They have successfully completed their 2020 funding plan. They're working on 2021, and they have 14 billions in liquidity. But when you look at how credit ratings are working on this chart, is they are investment grade, but we're talking about the lower medium grade. So if anything doesn't turn out the way Enbridge is promising it will, and if they cannot keep up with their debt payment and at one point in time have a rough time increasing their dividend, chances are their credit rating will be reviewed. So far so good, but keep a close eye because on those ratings, because they're not incredibly strong either. They're good, but at one point in time, if Enbridge doesn't fall in the good grace of credit agencies and lose its investment grade ratings, further debt will be a lot more expensive, and I don't think they'll be able to find all the financing they need to finance their capital intensive business. Keep in mind, they need to spend spend billions of dollars every single year to grow and maintain their business active. Let's look at how Enbridge intend to use its cash flow and its debt. The purpose here for the company is to maintain 4.5 times to 5 times debt over EBITDA. So basically having a debt that is roughly 5 times larger than their profit. Still kind of high, but as long as they stay within that range, it will keep their credit rating. I like that the long-term dividend payout ratio is around 65% of their distributable cash flow per share. We have demonstrate that in this video. It's all good for now. We're pretty much on target, slightly higher, a little bit closer to 70%. But then again, it's not the end of the world, and this gives them enough room to continue increasing their dividend going forward. They will use their money especially to fund their new projects. They have made some advancement for Line 3 replacement, which should increase their cash flow a lot. They have lots of projects in the renewable energy as well. And what I like is that they still keep in mind that they should pay down their debts. The moment that I will see a combination of growth, dividend growth, and then debt repayment, I think that we're going to see a stock price going a lot higher. In the meantime, I expect that the market will be a little bit worried about the overall situation. Probably it's going to get a lot better in 2021. In the meantime, I will keep my share and I will expect a dividend increase for 2021. I don't forecast any dividend cut at this point, and hopefully this video is not going to come back to haunt me in a few years. But I was a bit concerned over the past few months about my investment thesis around Enbridge. When I purchased the share back in 2018, the first time, I thought they're going to buckle up their financing, economic is healthy, and they're going to surf on that growing economy for the several years. It's going to be a great deal, but unfortunately, 2020 happened. It raised a lot of eyebrows, lots of questions, and we're not too sure about what's going to happen next. I decided to go back into my books, go back into their financial statements, revise the entire story. And right now, what I like a lot is they have proven they can pay their dividend. They have proven they can increase their dividend growth. And on top of that, they're moving towards natural gas and renewable energy, which is the thing that I like the most about the business, this ability to adapt throughout time and make sure that they will still remain relevant in the future. So for all those reasons, I will keep my shares, and I think that the dividend will increase in 2021. If you want to know more about how to analyze payout ratios and how to make sure that your dividend is safe, I've done a great webinar right there a couple of weeks ago. You can watch the replay for free. The subscription link is right below. You subscribe, and as soon as you subscribe, you put your name and your email address. You're going to be redirected to the replay. No strings attached. Presentation is about 50 minutes, and then I stick around for like an hour to answer all kind of questions about the stock market. You're going to love it. And make sure that you subscribe to this channel to get all my notification. Like this video if you have enjoyed it, and if it has given you a little bit more conviction about your shares on Enbridge. And until my next video, stay invested.